Hey everyone, ready for a deep dive into UK capital gains tax?
Sure am.
Today we're focusing on how it affects individuals and trustees. We're going to be looking at a recent blog post from MA and CO accountants to guide us. It's titled Understanding the Current Capital Gains Tax, CGT, Annual Exempt Amount for Individuals and Trustees,
Okay.
published November 28, 2024.
Right.
So whether you're planning some big financial moves or just curious about this stuff, this deep dive is for you. Let's break down this tax and figure out how it might hit your wallet.
Sounds good. Let's kick things off by defining capital gains tax, or CGT as it's commonly known. It's basically a tax on the profit you make when you sell something, like an asset that's gone up in value. It could be property, stocks, even a vintage collection, anything like that.
Gotcha. So it's the profit that's taxed, not the original price you bought it for.
Exactly.
Makes sense. But what about this annual exempt amount I keep hearing about?
Yes, that's your saving grace. The annual exempt amount is a threshold, you see. It lets a certain amount of that profit be tax-free every year.
Oh, interesting. And this threshold has changed recently, right? What's the deal with that?
Yeah, the blog post actually points out some pretty big changes.
Really?
Back in 2022-2023, the exempt amount was £12,300 for individuals and £6,150 for trustees.
Okay.
But now for 2024-2025, it's dropped significantly. It's down to £3,000 for individuals and £1,500 for trustees.
Wow, that's a massive drop. What kind of an impact does that have on people's tax bills then?
Well, it's pretty significant. With a much smaller exempt amount, more of your gains end up being subject to CGT. So that could potentially lead to, much bigger tax bills. That £10,000 profit from selling that vintage collection we talked about could look really different after CGT, depending on when you sold it.
Okay, that's got me thinking. So let's say I sell something and make a profit. How do I actually work out the tax I owe? Can you walk me through it?
Sure. First, you got to calculate your gain. That's the selling price minus what you originally paid for it.
All right.
The blog post uses a simple example. Imagine you buy something for £5,000 and then sell it later for £15,000. That's a £10,000 profit.
Okay, so far so good.
Then you apply the exempt amount. So in the current 2024-2025 tax year, an individual gets to deduct £3,000 from that £10,000 profit.
Okay.
That leaves them with a taxable gain of £7,000.
Right, I get that. So then what tax rate is applied to that remaining £7,000? Is it the same for everyone?
Well, that's where individual circumstances come in. The tax rate is determined by your income. For individuals, it can be either 10% or 20%. Most trustees face a flat 28% rate.
Okay.
There's actually a link in the blog post. It goes to a really detailed HMRC guide. It explains all these calculations.
Gotcha.
It can get a bit complex.
Yeah, I bet. I'll definitely check that out. Now, the blog post also mentioned something about married couples and CGT. What's the deal with that?
It's all about strategic planning. Married couples, or civil partners, actually each get their own individual exempt amount. That's if they own the assets jointly. So that means they could potentially shield a combined £6,000 from CGT in this current tax year.
So there's a definite advantage to being married when it comes to CGT. Interesting. Are there any other little nuances like this we should be aware of?
Yeah, there's one crucial thing. You can't carry forward any unused part of your exempt amount.
Oh,
If you don't use it in a given tax year, it's gone.
really?
No rolling it over or anything like that.
Wow, okay. So the timing of selling assets is super important then. You could really miss out if you don't plan carefully.
Right.
Does the blog post offer any real-world examples of how these exempt amount changes actually affect people?
It does, yeah. There's this case study comparing the tax owed on a £10,000 gain in both the 2022-2023 and 2024-2025 tax years.
Cool.
It really shows the impact.
All right, let's hear it. How does the tax bill actually change?
So in 2022-2023, with that higher exempt amount of £12,300, the whole £10,000 gain would have been completely tax-free. Zero CGT to pay.
Wow.
But now in 2024-2025, with that lower £3,000 exemption, our individual would be facing a taxable gain of £7,000.
And at a 20% tax rate, that comes out to...
£1,400 in CGT. Quite a difference from paying nothing, just a couple of years ago.
That's a real eye-opener. So we've established that this shrinking exempt amount is definitely something to pay attention to. But what can people actually do about it? Does the blog post offer any strategies for minimizing CGT?
Absolutely. It outlines several strategies for tax efficiency.
Okay.
One key tip is to spread out the sale of your assets across different tax years.
I see.
That way you're making the most of your annual exempt amount each year.
So don't put all your eggs in one basket, so to speak. What are some of the other strategies?
Another good one is transferring assets to a spouse or civil partner. If one person's used up their exempt amount, The other might still have some allowance left that can really help lower a couple's overall tax burden.
So a bit of financial teamwork can go a long way. Interesting. Anything else?
The last one they suggest is using any losses you might have on other assets to offset gains. It's all about balancing things out. Those losses could reduce your overall CGP liability.
That's a good point. So it's not all doom and gloom. There are definitely ways to be strategic about it. This reduction in the CGT exempt amount, it feels like it's part of a bigger picture, don't you think?
You're right, it does seem to reflect a broader trend. The UK government's been gradually lowering various tax-free allowances over the past few years. It's not just CGT, we're seeing it with the inheritance tax nil rate band and the pension annual allowance too.
That's interesting. So what's the thinking behind this trend then? Is it just about boosting tax revenue for the government?
Well, while that's certainly one factor, it's not the whole story. The government argues that these changes actually promote fairness, you see, and make sure that everyone contributes proportionally to public services. Their point is that lower tax-free allowances mean higher earners, and those with more assets, end up contributing more.
I see, yeah. But doesn't this also raise concerns about the impact on people who might be less well off?
It does. Critics say that these reductions disproportionately hit those with, more modest assets, people who are just trying to build some wealth. For example, imagine someone selling their first home to upsize. They might get slammed with a huge CGT bill, and that could potentially affect their ability to move up the property ladder.
Yeah, that's a valid point. It seems like there's this difficult balance to strike between generating tax revenue and supporting people who are working towards financial stability.
Exactly. Trying to navigate that balance is a real challenge for policymakers. There's no easy answer.
It's important for us to be aware of all these different perspectives. You mentioned earlier that there are specific rules that apply to different assets. Can you talk a little more about that?
Of course. When we talk about CGT, it's not a one-size-fits-all kind of situation. Different types of assets actually have different rules. Really?
Yeah, for instance, selling your main home is treated way differently than selling a second home or an investment property.
Oh, I see.
There are specific exemptions and reliefs available. For your main home that can significantly reduce, even eliminate, your CGT liability.
Oh, wow. So if you're selling your primary residence, there's a good chance you won't owe any CGT at all.
That's right. It's called main residence relief, and it can be a really valuable tool for homeowners.
Okay.
However, there are some conditions you need to meet to actually qualify for this relief.
Like what?
For example, you generally need to have lived in that property as your main home for the entire time you owned it.
Right. Are there any other asset classes where the rules are really different?
Yeah, investments like stocks and shares, they also have their own specific set of rules.
Okay.
For instance, if you're investing through an ISA, an individual savings account, any gains you make are usually tax-free.
Oh, wow.
So ISAs can be a very tax-efficient way to grow your investments. So the type of asset you're selling really has a big impact on the CGT you might owe. It just underlines how important it is to understand all these nuances. Are there any other tips you'd give to our listeners for navigating the world of CGT?
Well, I think the most important takeaway is getting professional advice is crucial.
Okay.
A qualified accountant can really help you understand the specific rules for your situation. Make sure you're claiming all those reliefs and allowances, and ultimately help you stay on the right side of HMRC.
Yeah, that's great advice. Trying to figure it all out on your own can be so overwhelming, especially with all the constant changes in tax laws. It's always good to have an expert in your corner.
Absolutely.
It seems like we've only just scratched the surface of this whole topic.
We have. Capital gains tax is a beast, but understanding it can be a real asset. No pun intended.
Definitely. We've decoded CGT, explored its impact, and even found some strategies for minimizing tax liability. What a journey.
And don't forget that blog post we've been using from MANCO accountants. It's a really good place to start.
It really is. Their insights have been super helpful for this deep dive. They really seem to know their stuff.
They do. If you're looking for more personalized advice, I'd recommend getting in touch with them. They can guide you through those complexities and make sure you're making the most tax-efficient choices.
Great point. Having an expert to walk you through this stuff can make a world of difference. What's one final thought you'd leave our listeners with about capital gains tax?
I think it's this. Stay informed. Tax laws are always changing. What we've talked about today might be different tomorrow, So keep up with any updates. And don't hesitate to reach out for professional advice when you need it. It's your financial well-being we're talking about.
Wise words. Knowledge is power, especially when it comes to managing your money. Well, that wraps up our deep dive into capital gains tax in the UK. Hopefully, you've got a clearer picture of this complex topic now and feel more confident to make informed decisions. Until next time, stay curious.
And the last suggestion is using any losses you might have on other assets to offset gains. It's all about balancing things out. Those losses could actually reduce your overall CGT liability.
Oh, that's a good point. It's not all doom and gloom then. There are ways to be strategic. This reduction in the CGT exempt amount, it feels like it's part of a bigger picture, wouldn't you say?
Yeah, you're right. It does seem to reflect a broader trend we're seeing. The UK government has been gradually lowering various tax-free allowances over the past few years. It's not just CGT either. We're seeing it with the inheritance tax nil rate band.
Yeah.
And the pension annual allowance as well.
Interesting. So what's the rationale behind this trend then? Is it simply about, the government trying to increase tax revenue?
Well, that's certainly a factor, but it's not the whole story. The government argues that these changes actually promote fairness, you see, and ensure that everyone contributes proportionally to public services.
Okay.
Their point is that with lower tax-free allowances, higher earners and those with significant assets end up contributing more.
I see, yeah. But doesn't this raise concerns about the impact on those who are perhaps less well off?
It does. Critics argue that these reductions actually disproportionately affect those with, more modest assets. People who are trying to build some wealth, take, for example, someone selling their first home to upsize. They might suddenly face a hefty CGT bill, and that could potentially impact their ability to move up the property ladder.
Yeah, that's a valid point. It seems like a difficult balance to strike between generating tax revenue and supporting people who are trying to, achieve financial stability.
Absolutely. Navigating that balance is a real challenge for policymakers. There's no easy solution.
Yeah, it's important to acknowledge these different perspectives. You mentioned earlier that there are specific rules that apply to different assets. Could you elaborate on that a bit?
Of course. When we talk about CGT, it's not a one-size-fits-all situation. Different types of assets actually have different rules.
Oh, really?
Yeah, for example, selling your primary residence. That's treated very differently from selling a second home or investment property. There are these specific exemptions and reliefs available for your main home, which can significantly reduce or even completely eliminate your CGT liability.
Wow. Okay, so if you're selling your primary residence, there's a good chance you won't owe any CGT at all then.
That's right. It's called main residence relief.
Yeah.
And it can be a really valuable tool for homeowners.
Okay.
However, there are certain conditions you have to meet to qualify for this relief.
Such as?
Well, for instance, you generally need to have lived in the property as your main home for the entire period of ownership.
Right, that makes sense. Are there any other asset classes where the rules differ significantly?
Yes. Investments like stocks and shares. They also have their own set of rules.
Okay.
For example, if you're investing through an ISA, an individual savings account, any gains you make are usually tax-free.
Oh, wow.
So ISAs can be a very tax-efficient way to grow your investments.
So the type of asset you're selling really does have a big impact on the CGT you might owe. It just shows how important it is to understand all these nuances, right? Are there any other tips you'd give our listeners for navigating the complexities of CGT?
I think the most important takeaway is seeking professional advice is crucial.
Okay.
A qualified accountant can help you understand the specific rules that apply to your situation, ensure you're claiming all the eligible reliefs and allowances, and ultimately help you stay on the right side of HMRC.
Yeah, that's sound advice. Trying to figure it all out on your own can be pretty overwhelming, especially with the constant changes in tax laws. It's always good to have an expert in your corner.
Absolutely.
It feels like we've only scratched the surface here.
We have. Capital gains tax is, well, it's a complex beast. But understanding it can be a real asset, no pun intended.
Yeah. We've definitely decoded CGT, explored its impact, and even uncovered some strategies for, minimizing your tax liability. What a journey.
And remember, this blog post we've been looking at from MA&CO accountants, it's a fantastic starting point for anyone wanting to learn more.
It is. Their insights have been really valuable for this deep dive. They clearly know this subject inside and out.
They do. If you're looking for more personalized advice, I definitely recommend reaching out to them. They can help you navigate all those tricky complexities and ensure you're making, the most tax-efficient decisions.
Great point. Having an expert guide you through this can be a real game changer. What's one final thought you would leave our listeners with about capital gains tax?
I'd say this: stay informed. Tax laws are constantly evolving. What we've discussed today might be different tomorrow. You never know. So keep an eye out for any updates, and don't hesitate to seek professional advice when you need it. It's your financial well-being we're talking about here.
Wise words, knowledge is power, especially when it comes to managing your finances. Well, that wraps up our deep dive into capital gains tax in the UK. Hopefully, you've got a clearer understanding of this, complex topic now and feel more empowered to make informed decisions. Until next time, stay curious.